Welcome to The Missing Link, a podcast where crypto and insurance come together. I'm Dan Roberts, and my co-host is Danielle Wall-Elliott. Whether you're in crypto, traditional finance, or in need of a new podcast, The Missing Link will help you explore the vital role that insurance plays in crypto and how blockchain will disrupt insurance. Join us on our journey to find the missing link. Hello everyone, an exciting one for you today. We have Sidney Powell. Sid is the co-founder and CEO of Maple Finance, and with his co-founder Joe Flanagan, launched Maple in 2021. Maple is transforming capital markets through technology, having facilitated over, I believe, $3 billion in loans since launch in 2021. During Sid's career in traditional finance, what hasn't he done? He's participated in $3 billion plus of corporate bond issuance, established and ran a $200 million bond funding program, and managed Treasury at a commercial lending FinTech company. Nothing short of the perfect guest for The Missing Link. We're very lucky to have him. In this episode, which really kicks off our guest podcast for 2024, he discusses Web2 finance as a tax on global GDP, the past and future of Maple, of course, AI underwriting, we couldn't resist, and a whole lot more. We hope you enjoy the conversation as much as I enjoyed the discussion. Enjoy. Welcome, everyone, and welcome, Sid. How are you?
I'm good, Dan. Thanks for having me on the podcast.
Welcome. It's a pleasure. Sid, I will let you take our listeners through a bit about your story and what Maple is up to at the moment. I wanted a quick sort of context setting to begin with. I feel like Maple burst onto the scene and introduced itself to the world primarily in 2021. I'm sure there were lots of problem solving and activity and so forth before then. And obviously that year was a pretty wild year for lots of people. Would love for you to take us through that story. But am I right in thinking that Maple is entering a bit of a new phase, a new chapter, as many companies are, that is focused around this sort of maturity, real institutional readiness, or is there more to that simplification? Would love for you to take us through that full start to end.
No, it's a good simplification. For those who aren't familiar with Maple, what we do is institutional lending on chain. And so you can think of this as being, we kind of have this call it like a dual stream approach, where we do crypto native lending. This will be funds, market makers. Mostly it's been secured or over collateralized of late, which most people within crypto are pretty familiar with. We've also in the past done a lot of unsecured lending to market makers. And then the second stream, which is kind of, it's almost its own business unit, is real world assets. And so this was a big thing in 2023. We were doing loans collateralized by T-bills, loans collateralized by CLOs, other real world assets. So tax credit receivables was another big one we were doing. But broadly, those two business lines kind of continue in parallel. So real world assets, crypto native lending. But it wasn't always that way. Like where Maple began, the initial concept, which was all the way back in 2019, was doing bonds on chain. And then we really had to kind of evolve the product and evolve what we were doing to cope with the fact that it was so early in this space. And that was how we eventually came to be a lending marketplace and then a direct institutional lender, which is what we've really focused on today, as we sit here in 2024.
Got you. And just take us right back to that 2019 moment. What was the real genesis of the idea? You said you started with bonds. Who came together around, that discussion, and, what were you setting out to solve?
Yeah, so my background was banking. So I used to work in an area called securitization. And this means we were working with large lending companies, and we would help them issue bonds so that they could raise money to lend out to their customers. So when a lending company that's not a bank gives you a home loan, typically they have borrowed from a bank, or they have borrowed by selling bonds to insurance companies, pension funds, other asset managers. And so I was in that space, and that was up until about 2017. And then I went to work at one of those financiers. So we would borrow from banks and other investors. And so the initial idea was, well, this basically exists in Excel spreadsheets back then. Could we tokenize it and start to do it on top of a blockchain.
Mm-hmm.
And that discussion was me and my co-founder, Joe, who both worked at the equipment finance provider, through 2018, 2019. And the initial discussion was, okay, could you just tokenize the bonds and then you make them tradable, programmable, suck a lot of the costs out through automation? And what we ended up evolving to, and this, I make it sound like it happened in a relatively short frame of time, but this actually took 2 years. So in 2019, we were trying to make a basic proof of concept. This involved me going to all of these meetups through Melbourne and kind of learning about what was happening with Ethereum, what was happening with the Web3 space, and meeting some developers, then doing a very basic proof of concept. And then what we found was there was no assets that you could tokenize and turn into bonds on chain. So then we had to do very basic peer-to-peer style lending just with our own savings. And that was like a 3 or 4 month process. And then eventually we got through the wilderness and kind of came out to, well, let's go back to what we know, which is how do we do this for institutions and for businesses who want to do lending for a living? And that's how we got to what Maple ended up launching in 2021. And from 2021, we had this kind of very large out of the gate start where it took us only 6 or 7 months to get to half a billion in loans done and $500 million assets under management on the platform. And it's been a roller coaster since then, but a ton of lessons learned.
Yeah. Well, exactly. It's also easy when you go through these, the early conceptualization of these ideas to, get lost in the rabbit hole. Not that you guys did that, but you're learning about all of these different things at the same time. And it seems like there are multiple, trends, multiple micro trends, ebbs and flows of new ideas that are coming in the space that all amalgamate in this general broader trends that, I'd love to get to. You mentioned tokenized real world assets and things like that. And, they all have their own adoption curve at different times. It doesn't always track just track the Bitcoin price and, the general market cap of the space. What people are talking about is, quite fragmented, but would love your take on, what the general aggregation of all these different trends look like. But we'll get there. Quick for a lightning round. We have 4 quick questions to throw at you. First one, rate your knowledge on crypto, 1 to 10. You can say one word or a short bit of context.
1 to 10. I'll probably give myself an 8. I don't think I'm as deep on technical knowledge as what an engineer would be, so that's why I wouldn't give myself a 9 or a 10. But I've basically used most of the protocols out there. I've done bridging, I've done DeFi, and I've been in here for a few years now, so I've been kind of building on the space since 2019. Investing in it since 2018. So yeah, I guess 8, but not a 10.
Strong 8, we'll take it. Rate your knowledge on insurance, given that this is a names podcast.
Very good one. It's not a question I get every day, but let's say knowledge on insurance is probably, let's say like a 6. Like I've never worked in insurance, but I know the ratios. So like I can probably talk more credibly on things like combined ratio than most folks. I also understand kind of the business model, putting capital to work, the concepts of insurance float. So not going to be as good as somebody who works in the space, but I think I'm pretty decent for an outsider.
Perfect. Insurance has lots of ties with all these other financial arenas that you play in. Favorite or one of your favorite projects in crypto, not on this call, perhaps an upcomer or an existing that you've been involved with or enjoyed from afar for a long time?
It's a good question. I am super interested in insurance markets. But the other thing that I've been pretty interested in lately, because I think it's super important for the space, is the evolution of stablecoins. So I keep an eye on 2 projects. I keep an eye on are Mountain Protocol and Athena, ETHENA, and then another one in the on and off ramp space, because it's super important for us and super important for crypto is Bridge. .xyz who's trying to be like an institutional on and off ramp. So I think folks like us need that as we start to try and engage with more traditional businesses.
Yeah, absolutely. We had Martin from Mountain Protocol on the podcast as well. It was a really, really great.
Oh, awesome.
So they're doing some exciting things. It's an exciting area for us as well. You're right on the tooling side. Perhaps we'll cover some of that a bit later as well. Final one on the lightning round, main area of education that you think is still very much needed for users, institutional or otherwise?
Ooh, it's a tough one. Let's say risk management, because I think risk management is probably what keeps a lot of larger institutions from participating in the space. And this would be, particularly lending, which is our area of expertise at Maple, is a perception that crypto lending is the Wild West, and that collateral doesn't really offer any safety, as compared with real world assets like, say, a house. Mm-hmm. So I think the more that we can educate some of these institutions, whether they be asset managers, endowments, pension funds, insurance companies, or banks, or even just family offices and high net worth investors, I think the more beneficial it'll be for the space, and the more willing they will be to engage with startups like Names and like Maple.
Yeah, exactly. I mean, you mentioned stablecoins earlier as well. It seems like they have, and are taking on the responsibility to do, in some part, that education to show, in our case, that it's sufficient for the purpose of claims, sufficient collateral to pay claims. How can they work with various different players and rating agencies and others in the space around that? Completely relevant for lending and all the areas.
I mean, one way to view the two stablecoin providers, which are, the two major ones being Circle and Tether, is that it's just a substitute for Visa. Like, if you look at the job to be done, the real job is to allow two parties, let's say you and I, to transact with each other. Currently, that job is not actually largely done by our banks. You and I typically wouldn't just transfer money from my bank account to yours. If I was buying something for you, we might use a debit card. And so then really, like, we're paying Visa and a few other middlemen in the way. Mm-hmm. And the fact that we have to pay a bunch of middlemen is why that fee has remained relatively static at 2 to 3% for a very long period of time. And I think stablecoins, so Tether, Circle, Mountain, the other ones I mentioned, are hugely important for that, because one way to view it is it's effectively a tax on the global GDP. For as long as we're going to be increasingly all transacting over the internet, the amount that we have to pay Visa and MasterCard and these other interchange services is just a tax on GDP and a friction against commerce.
Mm-hmm. I like that. Fees of remittance and payment as a tax on global GDP. I like it.
The whole finance sector actually is, if you think about it, because the job of the finance sector is to facilitate surplus capital into deficit capital uses. So somebody who's got too much money, or not too much, but somebody who's got money that they're not deploying, it should be redeployed into the economy so that it can generate innovation, jobs, productive output. And historically, I think it was something like 4 to 5% of the economy, and it's at like 2 to 3, somewhere between 2 to 3 times that at the moment in a lot of Western countries. And so this effectively represents regulatory capture, because the industry, so banking, like if you look at banking, it's been consolidated down to a few extremely large global systemically important institutions, and they're not allowed to fail. But it also means that they don't have any fee pressure on the types of revenue or the types of costs they're able to pass on to their consumers. That's what should be happening in a healthy capitalist society, is that new entrants should be able to come in and compete away those margins. And unfortunately, the regulatory setup in the finance sector actually prevents a lot of that from happening. And you can see the unfortunate impact is that you get players like JP Morgan, who are now into the double-digit percentage of US deposits. So those are systemic risks that I see with the current way that the system is set up. And I think blockchain allows a healthy new set of competitors to enter.
Yeah, absolutely. I actually think I had one of the lightning rounds as, did the government hate us or love us, or trying to slowly on-ramp their understanding. But, would love to hear a brief piece. I've heard you speak about it before around regulation. I mean, how do Maple approach regulation, regulators, that whole piece? You're very aligned with the institutions. It must be a core part of your conversations.
Unfortunately, yes, but not in the kind of way you hope. So there's not really a clear set of regulations in the US, and so there is increasingly recognition among lawmakers that this is problematic, and that the policy of regulation by enforcement has not really been effective in promoting innovation, nor in actually stopping kind of consumer harms, which is the other core tenet of it. But unfortunately, the way that we comply with regulation is through exceptions. And this means that you're naturally constraining the size of your business, because you have to operate under things like a Reg D exemption, which means privately offering products to only high net worth in accredited investors or qualified purchasers. It can't be offered for the general public. And this also means that if you can't do that, you're not promoting safe standards for the general public, because you're preventing the products from evolving to the point where they can serve the general public. Right. Now, the general public is allowed to invest. They're just not allowed to invest in kind of the cutting edge technologies that are out there. Those are reserved for accredited investors and for high net worths, which I think is problematic. People should be able to, eyes wide open, with full disclosure, take the type of risk that they want as investors. And I think that's what should take place in a healthy capitalist system. And the regulatory environment should also have as one of its goals to promote innovation and not solely focus on consumer protection, because consumers should be allowed to take the types of risks that they want, just not undue risks or things without appropriate disclosures. So that's the US. Offshore, similar type of setup. You kind of go for private placements and you deal with sophisticated and accredited investors. Europe has an interesting system that they're setting up with MICA. I do have concerns that they've probably gone a little bit too hard, too early. And as they found with their tech sector, it might actually kind of squash or prevent innovation if things actually become too hard to comply with in practice.
Mm-hmm. Yeah, it does seem to be that there is a growing reaction to some of the gray areas in the US, to some of these even onshore jurisdictions in other main locations around the world, to the regulatory piece. And it seems to be that stablecoins are up first in a way. You paused on stablecoins earlier. I think there's some exciting, perhaps largely unknown traction of stablecoins that are starting to measure up against Visa volumes. And I don't know if you have any metrics there, but it sort of leads well into a general lay of the land. I think that what we'd love to discuss is kind of the lay of the lending land. What actors are making moves in this space, and is it a fair summary to say you have your traditional lending methodology and platforms that have existed for a long time, and we had this smart contract burst of excitement and a new way of thinking about that, even on KYC, all of that in the earlier days, and to some degree these things continue. There seems to be, is it a fair positioning to say that Maple is one of a category of somewhat centralized entities that are using decentralized technology and rails to provide transparency and increased access to different kinds of products? I know that kind of centralization, decentralization, and back to centralization, or the reverse of that curve, are often trends that you see in these different kinds of markets. So, perhaps you could give our listeners a bit of a lay of the land over time, as well as what the current trends are in that sort of lending and on-chain space.
Yeah, for sure. So I think the way to characterize the product of lending on chain is that it's the same, it's effectively the same business as traditional lending, but you just have different distribution and which is a blockchain instead of sending money out of a bank account.
Mhm.
And you also have, other things that you can open up. So other benefits, say transparency. So I can see the flows of funds. Once money goes into the financial system, it's extremely difficult to track the flow of funds because, there's no real way to like track for a third party to track, say, a payment between Deutsche Bank and JP Morgan, right? It's opaque. It's entirely within the systems of those two banks. Whereas if you have, if I send a payment to you in stablecoins on the blockchain, that's visible externally, and so you can actually see all of the movements of money. And this goes for lending as well. If I gave you a loan, people would be able to see whether you've been making the repayments or not. They wouldn't necessarily know that it's you because all they'll see is a blockchain address. But it does give you the ability to prove to other third parties that you are, a good credit and you've been paying all of your interest payments. So transparency is one element. The ability to take collateral in a much lower cost, much more verifiable way is also a huge benefit of doing this on chain. And so, if I gave you a loan against Bitcoin, I can custody the Bitcoin. I can then sell it if it drops in price. Whereas if I gave you a loan against gold, you can, of course, try and ship me the gold bars, but it's going to be very difficult for me to keep them. Or we can have them with a third party, but that's very difficult for them to just sell those gold bars if something is going, if the price of gold is dropping. So crypto offers a much more flexible and lower cost way of doing collateralized lending, and that's probably a good place to segue into how the space evolved. So if you go back to 2018, 2019, you had the proliferation of the first DeFi protocols doing over collateralized lending. So Maker, Compound, then later Aave. And the idea was that you do this first because you don't have to assess your counterparty. So if your counterparty gives you Ethereum or some other large on-chain cryptocurrency, you can hold it and you can sell it if they're not making their loan payments. Whereas if I gave you just a personal loan, then there's the possibility that you might not pay me back, and then I have to go and pursue you through the court system. So very costly. I might not get anything back at the end of the day, and it might take months or even years for that to play out. And so that's why over collateralized lending was the first widespread form of this. Then as you fast forward to 2021, 2022, there was a lot of unsecured lending or partially secured lending. And this was because of the growth of the CeFi players. So you had, as you had broader interest in cryptocurrency taking place, a lot of people didn't want to have to worry about custody. And so there were these products that had very good user experiences associated with it, say BlockFi, Celsius, blockchain.com, Abra. What they were offering was an easy way to hold your crypto, get a nice yield on it. You didn't have to worry about it. You didn't have to worry about managing private keys. It was a very similar to like a Web 2 experience. What happened though was that the massive amount of, I do attribute this partly to zero interest rates, but because of the massive inflows of venture capital into the space and the massive run up in cryptocurrency prices, everybody was throwing money into these platforms. And it actually created a problem for them where they had to pay out, irrespective of whether they were lending the funds, they had to pay out interest on these deposits. And so that then prompted them to have to find more borrowers. And so you had this huge increase in the volume of loans and lending. And as with every credit cycle, what this meant was over time a decline in credit quality of borrowers. So looser terms, lower interest rates, higher borrowing limits, perhaps than what borrowers should have had. And eventually this kind of hit a crunch period in early 2022. And really from like April with Luna, we then started seeing a credit contraction. So you saw parties default like 3AC, and then the lenders who had been dealing with them, so BlockFi, Celsius, Voyager, then experienced their own, defaults and liquidity issues as customers wanted to pull their deposits. So that's kind of brought us through to 2023, and then I'll start to wind this up soon so the listeners don't get bored. But then 2023, everyone started to then focus on the lowest risk assets. Treasury bills had gone up in yield since mid-2022, and they approached 5%. And so then suddenly everybody wanted the most liquid, credit-worthy instruments they could, which was doing tokenized T-bills on-chain. And that's where you see things like Ondo, a product that we launched as well, which was doing cash management. And then as we get through towards the end of 2023, crypto prices started to rise again. And now where I think we are is kind of the beginning of a new bull market. And this will entail market makers wanting to borrow again, funds wanting to borrow again, people wanting leverage against Bitcoin, ETH, Solana, any of these other large cap tokens. And so lending will come back again. A lot of people were very quick to kind of say it was dead after 2022, but lending is, of course, the oldest financial product and the basis of modern money, right? So it was always going to come back.
I hear you. I mean, certainly if you take the first two categories, 2018-19 versus 2021 and 2, you've got the likes of Aave Compound Maker versus, if you like, if that's the appropriate term, Celsius and BlockFi were a couple that you said. I mean, obviously it's a clear win for the first, over-collateralized, decentralized platforms that remain big, successful programs today. And it's interest rates are always going to do their thing and surprise people and not go the way that they intended, or not stay at levels that are incredibly favorable to a particular business model. So it's there's obviously a lot of iteration that there's lots of iteration on the decentralized side, but it seems to be the initial DeFi protocols, really did something new that is sustainable, and these new centralized models have to iterate through solving those kinds of issues that came along throughout the sort of crunch throughout 2022.
Some of the DeFi protocols also need to solve the issues that happen in the same CeFi loans, right? So one of the big call-outs from 2022 was doing loans to, parties who did loans to Alameda against FTT tokens, because it was basically seen like correlated risk. Only the middle of last year, we saw a lot of DeFi protocols do very large correlated loans to the founder of Curve against the Curve token, and he held 50% of it. So same issue. Like ostensibly, those are mirror issues of each other, where you're effectively lending to somebody against equity in their own company, and there's a key man risk where if they stop, or depart the company, then effectively the value of that equity is worthless. And it was also done, at a level of concentration that probably would have rendered some of those DeFi protocols insolvent if they need to liquidate those tokens. So similar issues. I think risk is once defined by this really smart guy called Bernstein as more things can happen than, or more things can happen than you think will happen. And I think DeFi risk is just swapping some kinds of risk for other kinds of risk. You have more technology risk, liquidity risk, but less counterparty risk. But I think it's important not to. It's only when you think that something is risk-free that you're like really in danger.
Yeah, risk-free rates are a little too commonly talked about, and I guess there's also a compromise of returns, let's say, for capital providers that are backing a yielding product. If you're over collateralized, it's not capital efficient, but that's a provision that a DeFi protocol may have to make, because you don't have the benefit of a credit assessor or an actuary in the insurance world, or an underwriter that's going through the thinking on this. And I don't have the intention to get into an AI conversation with you. I know you've spoken about it before. It's it's a very common conversation at the moment. And what seems to be exciting is that it's been talked about a few times that the combination of technologies is starting to become exciting, with sort of AI and credit, for example, could be one of those combinations where you might be able to lean on the reduction in counterparty risk and a plethora of other benefits that the DeFi design makes, whilst adding in, theoretically, you could add in an AI type credit assessor that keeps it as a decentralized non-counterparty risk model. And the combination of those two worlds, you might be able to, if you look at the Venn diagram of pros and cons of DeFi and more centralized approaches, you can combine the benefits of both over time. I'm sure you're quite close to, the AI conversation. It doesn't seem to be in the insurance space that there's a huge amount going on, at least on the surface. That I'm sure there's a huge amount going on underneath, but on the surface, there's yet to be, an AI that's pricing risk more efficiently, connecting capital more efficiently to risk, and doing so at scale. But you would think that's not too far off, given the amount of data and data scientists that are working on these things and how quickly the AI tooling is going. Perhaps a minute on the AI piece when it comes to credit and your model in particular.
I think AI will be used in credit assessment to lower the cost. I don't think it'll entirely replace human judgment for a while yet, but imagine it this way. It's like if I've got a credit analyst who can assess 3 to 4 deals at once, maybe they can now assess, if they use AI more, maybe they can assess 10 or 14 or 20 deals at once. And then they just make decisions based on exceptions. You have an AI that says, well, we would grade this borrower as, a AA credit or a single A credit or a triple B credit. But here's these issues that we flag. How do you want to deal with it? Do you want to, cite this as a risk and kind of tighten the credit rating? And that's where AI would be a really useful kind of call it companion underwriter. So similar to how kind of chess evolved, where you had initially, an AI could beat a person, but then a person working with a computer could beat that for a while. But that's the way I would see it going with credit, is that a person working in tandem with AI will initially be much better at credit assessment, and they'll be able to do more deals. We actually saw it because I used to come from banking. I know for a while they were actually using automated scores in home loan mortgage approvals at the bank I worked at, but they had to stop it because it was deemed that it was going to be prejudicial to some borrowers. And so since banks are like a quasi arm of the government these days in terms of being regulated as too big to fail, what that meant is actually they deprecated that and just went back to assessing everything manually in Excel spreadsheets, or very basic approval calculators. And so I think you won't actually see any of that innovation come from banks. So it'll be a very long time before your bank loan is decided by an AI bot. But where you do see almost all the innovation in finance happens in the shadow banking sector. So large private credit players like Ares, Apollo, Blackstone, and the smaller lending companies who might be specialists in a certain area. So, we specialize in lending now to trading firms and funds in crypto. If we had a set of financials for a trading firm, there's no reason why within the next 12 months we wouldn't be able to start using AI to make recommendations on whether we would lend to that company. And then what it does for us is it allows us to keep our interest rates lower, or pass on more returns to people who allocate capital through us, because I don't have to have as many staff, I don't have to have as many highly paid staff approving deals, or I can have the same amount of staff approving twice as many or 3 times as many deals. So I see a lot of room for cost savings and growth and market share capture by using AI. And I'm going to have a better ability to do that because crypto is natively programmable. So stablecoins are very easy to program. Stablecoin loans are very easy to program, and that is super hard when you work with banks because bank systems are not set up to be very easily accessible via APIs.
Yeah, that's it. It seems to be the real innovation is enabling a next innovation to work with it. Like it's been a challenge, if that's what we're fighting for a new financial ecosystem to untether itself completely or quantify the benefit to in the traditional world to use new rails. But once a new technology is able to work with those new rails and is just physically not able to work with a traditional system, that's when the spread starts to increase.
What you see is some of the biggest haters of cryptocurrency are Web 2 fintechs because they felt like they, and I'm going to attribute some, try and represent their perspective, and hopefully I do it justice. But some of the biggest some of the biggest detractors from cryptocurrency are these Web 2 fintechs because they effectively have bet their entire company's tech stack on the idea that they can work and put a nice front end on legacy banking systems. And so it's very threatening for them to have this idea. Well, actually, we'll just be sending stablecoins to each other in the next 5 years. And so, why do you need to build on top of a banking system? You just build on top of a blockchain. And so, it represents it's basically an existential risk for them. Like, why would you pay when you use a Web 2 fintech, you have to collectively pay the fees of the bank who sits beneath them with very old systems, plus their fees on top for putting a nice front end on it. And what we found was that when a bank wanted to get into an area that was previously the province of a Web 2 fintech, they would just jack up the pricing to the fintech or make it harder for them to use their systems and then pay developers to build their own version of it. You saw that with a lot of the kind of payments processing firms, the Forex firms, or the debit card firms. And that can't happen with crypto because, Maple's not built on top of a banking stack. So as long as a bank cannot dictate, whether we are able to move stablecoins or not, we can continue lending as long as people wish to give us stablecoins. And that also means I don't have to pay any of the banking costs. And also what happens is that the stablecoin provider, as they grow, so let's say Circle or Coinbase, who are offering USDC, what's happening is they are getting more leverage with a small number of banks. And so you have the money will sit in accounts with those couple of banks. They will be able, Circle will be able to extract lower fees from the banks. And then we will just move money around in a digital format, which will be the stablecoin, rather than having to move money through hundreds and thousands of different banks.
Right.
And so that for us, that just untethers our platform, our business, our lending business, from the platform risk of a bank choosing to jack up the fees or make it more difficult for us to access their systems. So I think you're going to see a huge cost compression and deflation in financial services as more things move on chain.
Makes a lot of sense. That's clear. I'm sure there's a 15-year-old out there who's going to be on a podcast in 10 years, working in Web 4, saying that the Web 3 guys have laid their bed, or maybe it'll be you guys pioneering it, some sort of combination of interesting technologies. We touched a lot, just a penultimate question here. I think you touched a lot on the savings, even when AI comes involved, which I'm sure it's kind of out there that the actual quantifiable benefits of these things are unknown. But you mentioned lower number of underwriters per assessment, or that sort of thing. How do you guys think about quantifying the benefits, not of AI, but of on-chain activity? Is that something that you're able to quantify and put forward to the space to help some of the more traditional conversations that you're having with people that can adopt this new technology? Because I find that reasonably difficult to do, because the financial system is so fragmented. There are fees in lots of different places. Particularly in insurance, you've got all these different areas of the value chain that you can simplify, and tracking and transparency and liquidity, and tokenization doesn't just give liquidity, but it does create a dynamic to allow liquid market. The quantification piece of this infrastructure, I think, is an untapped entity in my mind for the space to bring forward, in a better way. How do you guys think about the efficiencies and quantifying that?
I think in a financial business, the main place where your efficiencies show up is in the cost to income ratio. So your cost to income ratio effectively represents, in a financial business, the cost of offering the lending, the lending service or financial product that you are, and so it represents effectively of your net interest margin that you earn. So how much revenue you get from making, in our case, how much revenue we get from making loans, and how much we have to pay out to the people who give us capital. And so what you do is you divide the cost of us operating that business by that amount. And so that's our cost to income ratio. That is where you would see these efficiency gains show up. And that's because that's where the reduced headcount shows up. That's where, having less stuff just kept and record kept on Excel spreadsheets, right, and SQL databases shows up for us. But unfortunately, it's actually very hard to quantify at a small level because we're subscale. If we were doing billions of dollars of loans per year, we've done about 3.2 billion since we launched, but that's over a 3-year period. If we were doing billions of dollars a year like a conventional bank, then it would be much easier for us to quantify it because we just have years of data to do. Unfortunately, it's kind of like when the car first came out, and when it first came out, it probably wasn't that much that much faster or cost effective than a horse. But if you followed the arc of technical progress, you could see that that's where it was going. And so right now, subscale, it's probably not that clear that we save a ton of money compared to a large financial institution who's operating at scale and just has a lot of those efficiencies dialed in. But the arc is that, probably with a staff of 1/10 or 1/100th of what one of those larger firms is operating on, we could probably at scale do the same amount of loans. Yeah. And so I think what you should look out for is that in the next few years, lending rates that are loans that are done on a blockchain and settled on a blockchain should be competitive with traditional finance loans. And where we would try and compete in the interim is on this initial wedge. So we have to find crypto native firms who are not going to get served by banks, serve them, then serving companies who are offshore or overseas, because it's much easier for us to send them money than it is for an American bank to send money to a customer in Japan, or Singapore, for example. And so that's where we can carve out a niche. And then, similar to Christensen's idea of market disruption, will then continue moving up market and try and take share in some of those more traditional business lines from those banks or credit funds. So I envisage a world where Maple in future is going to look a lot like Apollo does today. They're probably the financial group that I model us most on mentally, which is they have, dozens of different origination lines. They source capital from credit funds and an insurance product they built. But they are a lending business that is not a bank, and they have multiple diversified different places that they can deploy capital. And that's what I want Maple to look like over time, but will be a lower cost version of them, because unlike them, we will be fully vertically integrated, where we are controlling the stablecoins that we send out, whereas they will be using JP Morgan and these other sort of aging banking systems to manage all of their loans.
No, totally. It has to make sense at scale, and I think if there are ways to bridge the gap in the early days, for us, access to alternative capital in the insurance space is always in high demand. You're increasing access to a new asset class for capital, for on-chain capital providers. It sounds like there's, plenty, given your $3.3 billion figure, but, plenty of activity that can happen before this real, all singing, clean, tech stack that an entire ecosystem really can start using, and that is what I'm excited for, is like a physical number efficiency gain that makes the these next generation of players within obviously the insurance market in our world and the lending market in yours. It's the day-to-day activity that you can incrementally improve that becomes very powerful, instead of the big, the bigger pieces early on that are more of a bridge to that final incremental improvement.
Yeah. Well, like a level to shoot for would be trying to get your cost to income ratio to 20% or less would put you very much in kind of best in class in the lending space. So I think that's at least an early goal to shoot for.
Wonderful. Well, yeah, absolutely. Huge good luck to you and the team. We've been following Maple for a good few years now, so it's really an exciting next step, as you said. Hopefully, a strong market to come over the next cycle. Final question, as always, is what for you is the missing link. This podcast is aimed at exploring with industry experts the things that are going wrong, things that are going well. What do you think is still left to lead to a real next wave of adoption, and really a next wave of adoption up to that utopia, let's call it, of full industries using this efficient technology? So what's the missing link, Sid?
Well, I'll talk to two things. I'll talk to two aspects. I'll talk to the kind of the infrastructure and products that are needed, and then I'll talk to kind of the political environment. And so on the infrastructure and products, what we need to see is more stablecoins. So stablecoins and off-ramps are the two things that I want to see more of. So we're at about, call it 140 billion in stablecoin issuance. We really need to 10x that to 1 to 1.5 trillion. You just have a lot more commercial opportunities in a pool of 1 trillion in stablecoins. There's more borrowers for us, there's more lenders for us to find. That is kind of the oxygen we breathe. Then what you need is the bridges. So these are the on and off ramps so that we can get stablecoins to a customer, or so that we can take fiat from an allocator or a high net worth investor, bring that on chain. That's the on-ramping aspect. And then if we want to deal with a traditional borrower, then we have to be able to off-ramp it. So stablecoins and on and off ramps, two most important things, I think, for the next wave. On the kind of political legal side, what you need is a different regulatory environment. So you have probably, the most hostile regulatory regime that you can imagine in the US at the moment. But what the prediction markets are telling us is that there's likely to be a change in administration come November, and this would almost certainly result in a change in the leadership at the regulator in the US. And what I would envisage then is that perhaps you could see a softening of the approach there, where maybe they're trying more to foster innovation instead of either seeing it, aiming to see it quashed or shifted offshore from the US, which is the current posture. So I think if that happened, then you'd have a lot more traditional finance firms and large institutions who are willing to participate. When I talk to them at conferences, a lot of what they say is, well, we're already regulated by the SEC in this other area of our business. So if we did crypto, we're worried that they would punish us in the other area of the business, and it hurts their revenues. If you had if you had a different set of leadership that was perhaps more innovation friendly, then I think those institutions would be more comfortable engaging with the space. And you'd also probably see, maybe a settlement of the Coinbase lawsuit. And I think a lot of dominoes start to fall in favor of innovation. You probably see more founders maybe return who have gone offshore back to the US. And so that's the political, legal, regulatory side. So you always need both for any new industry to work. You need favorable and constructive regulatory and legal frameworks and social institutions, and then you need hard infrastructure, which is stable coins, on and off ramps.
Tooling, got you. On off ramps, stable coins, regulatory clarity. I think we'll add the regulatory clarity tally.
Regulatory clarity is not necessarily a good thing if it's anti-innovation, and that's one of the things. That's one of the issues I've always had with European regulation. GDPR is extremely clear regulation, but it's also anti-innovation, and that's why you don't have a tech sector, in mainland Europe. But if you have a favorable, pro-innovation, constructive regulatory environment, that would be more beneficial, even if it's slightly unclear.
Got you. Yeah, no, that's an important distinction. Regulatory clarity seems to be the buzz when it comes to what development regulatory wise. But
a ban on crypto would be totally regulatorily clear, but it would also be disastrous.
Yeah. No, I'm with you. Well, instead of adding it to the regulatory clarity tally, which was one of the mean missing links in the montage that we put together for last year, the 12 missing links last season. Go check that out. We'll create a new one of the right regulation, but it would be good if once it's right for it to be clear as well. So yeah, Sid, thank you so much for your time. We thoroughly enjoy following Maple's journey and a very exciting wave to come. So thank you for being with us on the missing link, and good luck.
No, my pleasure. And if anyone wants to find out more about us, our website is maple.finance, and you can follow me on Twitter @SyrupSid, or Maple is @MapleFinance, one word, on Twitter. So, would love to see anyone reach out if they have more questions. But otherwise, Dan, thanks so much for having me. It's been a pleasure.
You're welcome.
We're one step closer to finding the missing link. If you enjoy our show, please rate and review us wherever you get your podcast. And be sure to come back next month. Until then, we are the missing link.